Technical analysis can seem a bit much when you're just getting started. Charts full of candles shooting up and down, lines all over the place can make it feel way more complicated than it actually is. But the truth is, once you understand the basics, technical analysis is one of the simplest and most powerful tools you can use in trading or investing. So in this video, I'm going to break it all down and show you exactly what you need to know to get started, in a way that actually makes sense. At its core, technical analysis is all about studying price. It looks at how price has moved up and down in the past to help you make better decisions about what might happen next. It's not about having a crystal ball or magically knowing the future. It's about stacking probabilities in your favor. You're simply asking, is the price more likely to go up, down, or stay where it is? And to answer that question, most traders use three main tools: candlestick patterns, drawing tools, and indicators. Let's start with candlesticks because they're the foundation of everything else. When you open a chart, what you're actually seeing is usually a candlestick chart, and each candlestick tells the story of price over a certain period of time. When you look at multiple candles in a row, we start to see candlestick patterns. These are shapes or combinations of candles that give us clues about what the price might do next. Traders often use them to help decide when to enter or exit a trade. They're kind of like signals that something could be about to change. Think of each pattern as part of the market's story. Once you learn to recognize these patterns, you can start to predict what the market is feeling by looking at whether buyers or sellers are in control of the price. It's like the chart is telling you a story about who's winning the battle and what might happen next. Each candlestick gives you a snapshot of what price did during a specific period of time, kind of like a mini battle between buyers and sellers. The thick part in the middle of the candle is called the body, and the thin lines sticking out above and below it are called wicks. The body tells you where the price started and where it ended during that time frame. If the body is green, it means price started lower and ended higher, so buyers were stronger and the market moved up. If the body is red, price started higher and ended lower, meaning sellers were in control and the market moved down. The wicks show how far price moved beyond the open and close, like little spikes that tell us how extreme things got. The top wick shows the highest point price reached, and the bottom wick shows the lowest point it dropped to, even if it didn't stay there. So, a candlestick gives you a really helpful visual summary of what happened during that time, where price moved, who was in control, and whether there was any hesitation or rejection. And when you line up lots of candles next to each other, you start to see the rhythm of the market. The pushes up, the pullbacks, the turning points, all of it laid out in a way that's easy to read once you know what to look for. That brings us to a term you'll hear often, a reversal. A reversal simply means that price was going in one direction, either up or down, and now it looks like it might be turning the other way. One of the most well-known reversal signals is called the engulfing pattern. It's a two-candle pattern. A bullish engulfing happens when a small red candle is followed by a much larger green candle that completely covers or engulfs the previous one. That tells us buyers have taken control and price might start heading up. A bearish engulfing is the opposite. A small green candle followed by a big red one, showing that sellers have stepped in and price might start dropping. So, instead of trying to memorize 100 different candlestick names, just focus on the basics: the shape of the candle, where it shows up, and what it's telling you about who's in control, the buyers or the sellers. There are loads of candlestick patterns out there. Some traders spend years studying and perfecting them. If you're interested, there are plenty of books, videos, and courses dedicated entirely to spotting these patterns. But the good news is, you don't need to learn them all to get started, and you don't have to spot all these patterns manually either. There are some great indicators available on a platform called TradingView, one of the most popular charting platforms for traders. It lets you view live price charts, add tools, and do all your technical analysis in one place. If you'd like to support the channel, feel free to use the link in the description to check out TradingView's paid plans, or you can simply create a free account to get started. I strongly recommend grabbing a paid plan during Black Friday, as they usually offer big discounts and it works out much cheaper. While candlestick patterns often focus on up to 3 candles at a time, when you start looking at how many more candles form together, that's when the bigger picture begins to emerge, and that's where chart patterns come in. Chart patterns are shapes that form when you connect multiple candlesticks together. Instead of focusing on 2 or 3 candles, you're looking at how price has moved over a longer period of time. These patterns tend to repeat themselves, and they can give you a quick sense of what the market is doing, whether buyers are in control, sellers are stepping in, or if things are just moving sideways. They're really useful for spotting the overall direction of the market. And just like candlestick patterns, chart patterns can help you spot possible entry points for trades. Once you learn to recognize them, you're not just guessing what might happen. You're using patterns that have played out many times before. Remember the saying, though, history doesn't always repeat, but it often rhymes. One common example is the descending triangle. This pattern forms when price keeps making lower highs, meaning each time it moves up, it doesn't go as far as it did before. At the same time, the lows are hitting around the same area, creating a sort of flat base. Visually, it looks like a triangle that's slanting downwards. This shape often shows that sellers are becoming more aggressive, pushing the price down quicker each time. Traders watch this pattern because it can signal that a bigger move might be coming, especially as the price starts to squeeze tighter inside the triangle. You can also use a free tool on TradingView called All Chart Patterns, which automatically highlights these patterns on your chart so you can review and learn from them as you go. Indicators are tools that take past price data, like where price has been or how quickly it's moved, and turn that into something visual to help you understand what's happening in the market. They often show up as lines that follow price, or as signals that highlight when something important might be going on. Let's break down some of the most popular indicators and concepts you'll come across. The purpose of indicators is to give you extra clues, like whether the market is trending, slowing down, or stuck in a range. Some can tell you if price might be overbought, getting too high, or oversold, getting too low, which can be a sign that a reversal or pullback might be on the way. Others help confirm if a trend is continuing or starting to shift. So, while they're based on past data, they're often used to guide what you might want to do next, whether that's buying, selling, or waiting. One of the most common and useful concepts you'll come across is support and resistance levels. These are key price levels that the market tends to react to. A support level is where price has fallen to in the past and then bounced back up. Think of it like a floor that price struggles to break through. On the other hand, a resistance level is where price has risen to and then turned back down, acting like a ceiling that price finds hard to break above. These levels don't just appear once. They often get tested multiple times, and when they do, they become even more significant. These levels can give you strong clues about where price might react in the future. If price approaches a resistance level, it might reverse or break through. If it's nearing support, it might bounce or break down. To save you the hassle of drawing these manually, there's a TradingView indicator called Support and Resistance Dynamic, which highlights key support and resistance areas automatically. Another vital concept is trend. Is price generally going up, going down, or moving sideways? Identifying the trend helps you align with the overall direction of the market instead of trading against it. The Super Trend indicator on TradingView is a simple tool that shows you this clearly. Green means uptrend, red means downtrend. It adjusts in real time and helps you avoid trading against the flow. You can also use trend lines to spot where price has bounced off in the past. Trend lines are one of the simplest ways to spot the direction of a market. They're literally just lines you draw on a chart to connect the highs or the lows, helping you see if price is trending up, down, or moving sideways. But if you want a tool that does this automatically, and a bit more precisely, that's where linear regression comes in. A linear regression channel is basically a smarter version of a trend line. It uses maths to draw a central line through the price data, along with two lines above and below it, to show the typical range that price tends to move within. Think of it like a moving trend tunnel that adjusts to the overall direction of the market, giving you a clearer picture of where price might be oversold or where it might be overbought. There's an indicator in TradingView called Linear Regression Channel that makes this really easy. Just add it to your chart, and it'll automatically show the average direction price is moving in, along with a channel around it. If price is near the top of the channel, it might be overbought. If it's near the bottom, it might be oversold. It's a great way to spot potential turning points at a glance. Moving averages are lines that smooth out price over a certain number of candles, making trends easier to see. A 50-period simple moving average, SMA, for example, shows you the average price of the last 50 candles. If price is above the line, it's often considered an uptrend. If it's below, it might be a downtrend. On TradingView, you can use an indicator called Many Moving Averages, which plots multiple SMAs on your chart so you can compare short-term versus long-term momentum in one glance. Lastly, let's talk about volume, one of the most important but often overlooked parts of technical analysis. Volume tells you how many trades are happening at different price levels. Think of it as the fuel behind price movement. If the price moves sharply on high volume, it usually means that the move is strong and supported by a lot of traders. But if the price moves the same amount on low volume, it might not be as reliable. There's less conviction behind it. One really helpful tool for this is the VRVP indicator, which stands for Visible Range Volume Profile, and it's available on TradingView. Instead of showing volume at the bottom of the screen like a traditional bar chart, VRVP displays horizontal bars directly on your price chart, making it much easier to see where most of the buying and selling has taken place. Blue bars show buying volume, yellow bars show selling volume, and a red line runs through the busiest area. This is called the point of control, which marks the price level with the highest amount of trading activity. These areas often act like magnets that price is drawn back to, or like walls that price struggles to break through. That's the basics of technical analysis. All of these concepts and indicators can be explored in more depth by simply searching them online. Thanks for watching. Please like and subscribe for more content.